I think I'm going to go ahead and get started just to be conscious of everyone's time. I saw a car pull in, but they could join us late. Um, Thank you all for being here today. Everyone's spread out, so I'm going to have to talk wide. But I'm Caroline Chandler, and I work with Banker Exchange. Banker Exchange is a qualified intermediary that specializes in 1031 exchanges. And we're going to learn all about 1031 exchanges today. So I've been with the company for 9 years now. I've had several different positions at the company, but currently in the business development role. I've also been an exchange coordinator. So I've worked with the client on the transaction, more in the operations. So I know how all that works, as well as giving you all the education on it. So our company was founded by a guy named John Boyd about 33 years ago. He's CPA by background. We're in Greenville, South Carolina. We also have a Charleston office, and we have a Colorado Aspen office. So you might guess our CEO moved out to Aspen, and so we can do 1031s across the U.S. We don't have to do them just in South Carolina or just in North Carolina. We can do them everywhere. We try to avoid California, but we can still do California. And we cannot do Nevada or Idaho, but pretty much everywhere else we can.
Why are you staying?
Yeah, so you have to be certified in some of the states, and it's just not worth it for us. We don't see a ton of deals in Nevada, so it's not worth us to be certified in that state. If you have a client in Nevada, we can always refer out to a QI that we know that works in that state. So here's the agenda. It works. So I'll talk about an overview of 1031 exchanges, all the rules and regulations of a 1031 exchange. I don't know if anyone, I feel like I've seen you before. Have you been in one of my presentations? Okay. This is going to be different. So you're in for a treat. This one, we're also going to cover case studies. So after learning all of the rules, we're going to put them in real life situations. These are real clients. Most of them have completed their exchange, so I also have the outcome of what happened with their exchange. And then I'll talk about the benefits and then have time for questions, but feel free to interrupt me throughout the presentation. I like to make these as casual as possible. If you have a client question, a personal question, ask me and I'm happy to help. So starting with the overview. So what is a 1031 exchange? A 1031 exchange allows real estate investors to defer paying capital gains taxes on the sale of an investment property if another similar property is purchased and specific requirements are met. So we're going to break this down, going through each of the requirements for the deferral exchange. So there are 4 requirements, and all 4 of these must be met to fully defer capital gains taxes. You'll hear me say fully defer capital gains taxes, because that is the goal, to fully defer them. But I will also share at times where you can do partial exchanges or you can do partial 1031s. Yes. So here are the 4 requirements. So let's start with the qualified use. What types of properties qualify? Raw land, single or multifamily rental, commercial properties, ground leases, easements, tenant in common interest, all qualify. Types of properties that don't qualify would be your primary residence, vacation homes, second homes, timeshares, stocks, bonds, and notes. I will mention vacation homes, as I said, do not qualify, but vacation rentals do. So the beach rental, the mountain rental, the lake rental, as long as their personal use is limited during that rental period. So that vacation rental use for personal use is either the greater of 14 days or 10% of the days that it's rented. However, anytime you're going to do a project at the house or any maintenance does not count as personal use days. I have a family friend who has a beach house, and every time we're there, we're doing a project. But yeah. But my boss recommends that you are not say you're building stairs and each week you're going to build 1 stair. No, you should get there, do a project, and then come back. But if you're pretty much renting it out on Airbnb, those types of things, the rental will be fine. You can also go in and out of qualifying for a 1031 exchange with the vacation homes, second homes, personal homes. So let's say your client has a lake house. It's truly a second home, but they're just not using it as much. Let's say the kids are getting older, they're not really going there. If they start to rent it out, they could then qualify for a 1031 exchange if they rented it for at least 1 to 2 years. Then they could sell it and it could be defer the taxes. Yes. Same with the opposite. They have a vacation rental or they have a rental house in general. A lot of people, I see this for retirement. Down the road, they want that to be their primary residence. They buy it within the 1031 exchange. They defer from their sale. They're owning this property, they're renting it. And 2 to 3 years, they move into it as their primary residence. So you can have that attention down the road that you want to use it for personal use. But the goal is when you buy it right now, it's going to be for the investment purpose. So a few other things when talking about establishing qualified use, the duration of ownership. We just kind of talked about the 2-year mark. However, there's nowhere in the IRS that states how long the property has to be held to qualify for the 1031 exchange. 2 years is that safe period. Longer the better. Also, some CPAs are good with 1 year because that's 2 different tax years. However, there is an exception to this rule. And as you see me go through this, there is a lot of exceptions to a lot of the rules. The exception to this rule, sorry, I saw something on the screen. What is an unsolicited offer? So let's say your client bought a rental house yesterday. They're getting ready to fix it up to put a renter in it. They're painting it. Someone comes, knocks on their door and says, I want to buy your property. Their intention was to rent it, to keep it, to put a renter in it. They never marketed it. No one even knew it was available. Someone else just came up to us. So unsolicited offer cuts that 2 years. They could sell and do a 1031 exchange tomorrow. No penalties. So they didn't own it for 2 years, but that's an exception to that. Basically, if you're not marketing it for resale and you're holding it, your intentions are to hold it. You'll see a lot of available signs around because no one knows what it's available for. It could be available for sale. It could be available for rent. It could be available for lease. Who knows? It's just available. So that also kind of gets around that they didn't market it for sale. It's just available. Nature of use, just making sure it's used for the rental, the business, trade, or investment. Make sure your personal time is limited when it is. Also, flippers don't qualify. Their intention is to resell. Anytime someone's intention is to resell, the nature of use is not to hold it for investment. And keeping good records and documentation in case the client were ever to be audited. I always say, if you are doing right by you and your CPA and the Lord, you're going to be fine. Some people are like, they tell me something totally different than what they tell their CPA. We go off with what they say. So, but if you're dotting your I's and crossing your T's, the client's going to be fine. Any questions with qualified use? Nope. Next is the value requirements. So the value requirements, I'll use a few terms. The relinquished property is the property being sold, and the replacement property is the property being purchased. Okay, sorry. I did a different presentation this week, so we're going to go through each of these. So starting with the equal or greater value requirement, that is looking at the value of the property being purchased, or the replacement property needs to be equal or greater value than the property that's being sold, or the relinquished property. So if the property is sold for $500,000, the value of the property or properties that they need to go look for needs to be at $500,000. There's the reinvestment of proceeds. So that is the proceeds from the sale. So that's minus all the closing costs would be the proceeds. That amount of money that normally goes to the seller, but in a 1031 exchange, it's coming to the QI. And that amount of money needs to be reinvested into the next property or properties to fully defer capital gains taxes. Now here's the partial exchange. So say your client needs some cash out. They need 50 grand out for personal use. They could take 50 out for the closing of the sale, reinvest the other portion, but that 50,000 would be subject to capital gains taxes. It's not an all or nothing situation. So you could still defer what you did roll over and pay taxes on you don't. Another situation with that is your client just wants to buy a lower value property. They would just pay taxes on the difference. A misconception here is that you only have to reinvest your cash. You actually have to be in the same position with your debt or your mortgage as well. So that payoff amount at the closing of the sale is the amount that has to go into the next property or properties to fully defer capital gains taxes. You can also bring new cash to offset that debt. But same kind of situation. Let's say your client doesn't want to get a new loan. They're like, I'm just paid off this loan of a great interest rate and now they're making me go get this other one. They could just reinvest the cash and pay taxes on the debt portion. And then boot is a fun word to say, but a not so fun term in the 1031 world, because anytime you receive boot, it is subject to capital gains taxes. So boot can be in that cash out at the closing of the sale. Boot can be any personal property. Boot could be not meeting that debt requirement, and boot is subject to taxes. Any questions with the value requirements? Nope. Next is the mandated timeline. So if you've heard of a 1031 exchange, I'm sure you've heard that they have very strict timelines. That is true. So day 0 is the day the relinquished property was transferred. Funds transferred, deed signed, that is day 0. From day 0, the client has 45 days to identify properties. And then from day 45, an additional 135 days to purchase something that they've identified. So the full process is 180 days. Now, these are calendar days, not business days. The weekends and holidays are included in this count. And I will just tell you now, 45 days flies. No matter what, it might go slow for us, but it flies if you're under a 1031 exchange. I think I do. Okay. So here are the ID rules. So I always joke that the IRS gives us rules and then they give us more rules. So on day 45, an identification form is due. It is due by midnight of day 45. Again, it doesn't matter if it's a weekend, holiday, your birthday, Christmas, 4th of July, it's due on that day. And it has to be emailed to us. I think I have a picture on here, actually. I do. So here's what the identification form looks like. It is basic paper that you're writing addresses on. So the addresses that get written on this paper do not have to be under contract. However, we suggest that you're kind of close in either negotiation or just serious that you want this property, not just listing a property for the fun of it to list one. Some people do. That's a different kind of strategy that I'll touch on in a little bit. But for a 1031, you want to write real properties, and they have to be very specific. They can't just say the corner of Main and Stone. Which corner? There's 4 corners. List exactly what you're buying. So if the IRS were to Google that property, they would know exactly what you're trying to buy. Same with land. I always say, send us the tax map number. If you're only buying a portion of that tax map number, print it out, highlight which portion. So there's no questions. But back to the rules. So let's use an example that our client is selling for $2 million. They're selling for $2 million and they're getting ready to fill out this form. And I will say a lot of clients their realtor is really involved in this process. That doesn't have to be, but I will say a lot of times the realtor is emailing me to make sure that that's being followed correctly. So the first is 3 property rule. They could list 3 properties and the value doesn't matter. So one could be for 2 million, one could be for $1 million, one could be for 500,000. The next rule is the 200% rule. So this is if they want to list 4 or more properties. So in our little example, let's say they're going to write 6 properties. To fill in this paper out, they wrote 6 properties and their fair market values do matter. You must total up all of their fair market values, and the total cannot exceed 200% of what they sold for. So in our example, 4 million. And this doesn't mean that you're going to buy $4 million worth of properties. I had a client yesterday, he's like, I'm not going to buy that much property. I'm like, I understand that, but you have options to write more over your, up to the 200%. The last rule is the 95% rule, which it's kind of a crazy rule, but if you do exceed that 200% rule, then you must purchase 95% of the things that are listed. It works in some situations, and most of the time it's when they're buying a huge portfolio or they're buying as tenant in common with other investors where they're going to be buying way up in value. Most of the times our client sticks with the 3 property rule or the 200% rule, and we work with them to make sure that this form does not get messed up. So if, a lot of people, I only want to buy this one property, but I want 12 backups. It's not going to work unless you're looking for, lower value of properties. We're like, hey, let's go back to the 3 property rule. You need to take some off. Yeah.
Let's just for easy numbers.
Yeah.
$1 million.
Yes.
That's what they need to do. Can they do 2 $500,000 homes, or does it have?
Yes. Yes, you can split it up in any way that you want to, as long as you're hitting that same value of what you sold for. Same with, you could add 2 sells into 1 buy. And there's not a limit on how many properties you buy. It just gets hard when you get your identification. I will say any property bought prior to day 45 is deemed properly identified. A lot of our guys that buy huge portfolios are closing all before day 45, so they don't even have to identify on their ID form. But they've used all their money by day 45. Let's say they had one other property that was closing after day 45, they would have to identify all of those properties. Sometimes you could, if they're selling in like a portfolio, he could list it as one, but you want to make sure he's buying all as one closing. And same with your cash and your debt requirement, you can split it up. So let's say you wanted to buy 1 property in all cash, and 1 property you were going to use some cash and some debt, or outside cash. You also have that flexibility as well. Good question. And so I covered the rules. Does anybody have any questions with the identification form?
It says up to 3 properties. What if they only see 2?
Correct, totally fine.
Okay.
Some people do write just 1. I always suggest write a backup, even if you're 1000% sure you're buying that property. I've had a lot of people say that to me, and then something happened to that property. Because after day 45, you cannot add or change anything to that ID form.
Can't change the property.
No.
It's not on that list.
Let's say you turn your identification form on day 45, you list 1 property. Day 50, something happens to that property, you're stuck. You can only buy that property. And we have to hold your funds till day 181, because the IRS sees everything that's always for sale. So even though it's not doesn't work for your client, it's for sale. Every property is for sale, even if it's not on the market for sale.
So they don't have to close on it, but the money's tied up until that 180 days.
Yes.
And then they're gonna pay capital gain.
Yes. Yes, go ahead.
Stupid question.
No.
What is your role? Plus?
My role, personally?
No, but are you?
Or a company? So we're a qualified intermediary. So we're that third party to the transaction, or you might hear it as a QI. We are holding the funds through the transaction. And we work with the closing attorneys or title companies on the closing statements to make sure they reflect the 1031 exchange rules.
And law firms do that frequently too.
Law firms can also be QIs, correct. However, you want to make sure as the client, you aren't also using that attorney as your closing attorney or have any relationship to that attorney. So really, yes, your broker, your banker, your realtor, your financial advisor, anyone can be a QI. But if you have any type of personal relationship or have done business with that outside person, they should not be your QI. Some people, for Truist, they have their own QI. I bank at Truist. I can't do it. I shouldn't do a deal with them. Because you've broken that interdependence relationship. So we are a third party. We only play the hat of the QI. We're not your broker. We're not your attorney. So if your clients are using attorneys, I know I think there's an attorney here in Nashville that does some, you want to make sure that your client has no personal business relationship with them.
It can be a law firm you're working with generally.
It could be in the gray. It shouldn't be.
Or just not with that client.
Correct. Sometimes there is an attorney in Greenville who sends me a lot of clients because those are his clients that he should not be closing for. But another attorney in the firm, it might be their client and he closes it. And that can still be, if he's following the QI rules, you should be fine, but it could be risky.
You have to identify the capital gains, so I'm just thinking, if you have a backup offer, if you have 2 properties in the contract, some seller is gonna get the whole part broken. And then their house is gonna go back on the market, so like,
Do you
you
have,
have to identify that in the offer to purchase.
you don't have to tell anyone that you're in a 1031 exchange. We have a clause that we like to see in a contract, but it's not required. It just basically says either party may do a 1031 exchange. It's not required. Some people don't want it in there. They don't have to put it in there. And it doesn't lock you into, even if it's in there, it doesn't lock you into doing the 1031 exchange. But some people think they're going to lose their advantage if the other party knows that they're in a 1031 exchange. Especially with price. People who are on the other side know how much money that, sometimes they'll say, well, I know how much you have to spend. I'm going to raise it high. They could just play those games. No, you'd never have to disclose that you're in a 1031 exchange. Those good questions. So what were we talking about? Oh, the 45-day is due on the 45th day. And there's no extensions. I've kind of said that. The only exception to that rule is if there's a federal declared disaster in the area and the IRS agrees. So Helene is the great example. North Carolina got extra extensions as well. So you're still in it.
Yeah.
And so for the 1031 exchange, it pushes out the 45th and 180th day to the same day in a lot of extensions. And I know North Carolina's went for the 1031 a full year, and normally it's a good 6 months. I had a client call me yesterday and they can't find anything. It was a realtor. The realtor couldn't find anything for her client to buy for the replacement property. Is there any way we can extend it and get more time? I'm like, no. I said, the only way is if there's a natural disaster, but we don't wish those on ourselves. So
So the deal
Yeah.
falls through and the person that has the money has to reinvest. Like if they have to start all over again with the new property,
so if the property falls through that they identified
it's gone through this process. They,
and then the exchange expires, they would get their money back and have to pay taxes on it.
oh, so this is, you need to make sure when you are going the person, you have that time limit and that's all you have. If you miss that, you miss the money to reinvest.
Right. If you aren't able to purchase anything, so we're holding the money and we would return it back to the client. And once it touches their hands, they have to pay capital gains taxes on that year that they received the money. So if they receive it in 26, they would pay when they file.
Until they find the exchange.
So once the 180 days expires, they're pretty much out of luck. You have to pay taxes. You can't enter back into one unless you're selling something else.
Paying tax on it, whatever you have left, and reinvest that. It's not gonna be a 1031 exchange, it's gonna be an investment.
You just have one shot.
That's basically
Yeah. because
on that sale.
On that sale, that's where I need to get to. So that's it. So on that sale, then I have to start all over again.
On a different sale,
Buy
yes.
Another property, identify and go through that, the days.
Yes.
It's just the process.
I have a question.
Yeah.
Let's say I identify 3 properties that I wanna purchase, but then all 3 of those drop off. And I'm within the 180 days and I find something else, can I change?
But you're after day 45,
I'm after day 45.
you cannot change or add.
You can't,
Yeah.
okay, but you could list you could list 3, knowing that it might only be 1,
Correct.
but.
Right.
So
You don't have to buy everything you've listed.
Okay,
Some clients don't buy anything they've listed. We're about to be at that part of the year, July 5th, 180 days is in 27. So some people don't want to take the loss this year. So that's where I said some people just write addresses on an identification. The bad part about that is their money is held up for 180 days, which is 6 months. But they don't want to take a loss this year and they're selling. They don't want to buy anything. They get their money back in 27. They don't pay all those taxes till they file for 27.
got it, so they're just.
They're just
they're
deferring a
playing
year.
fast
They are.
Yeah, okay, interesting.
But for your example, they would be out of luck.
Okay,
They can, after day 45, you can't change or add anything,
okay, so.
even
list
if
more-
everything falls through.
List more than you might actually buy.
That's why when people are like, oh, I'm 1000% sure I'm buying this, I'm like, please write it back up.
Yeah,
And some people are like, no, I don't need to. And I'm like, I've told you. And then
Yeah.
most of the times you have that conversation and they're mad because they can't get their money and they have no backups.
so it is not a placeholder, it is, I'm committing to something.
Right. Or you don't have to buy, but the goal is to purchase something.
Yeah. That's why you're saying try to identify. real
Yes.
properties.
Right. And start, if you have a client that's like, hey, I'm selling in 90 days, I think I might want to do a 1031 exchange, start looking for the replacement properties. You can be under contract on what you're going to buy before you sell. Contract date does not matter. It's just the closing date. Someone asked me that yesterday. I'm like, yep, totally fine. But we have so many clients that start on day 0 and say, oh, I'm gonna go look for what I'm gonna buy. I'm like, good luck.
Yeah.
And normally those type of people don't have realtors or brokers to work. I'm like, can I refer you to someone? Because just searching the Zillow might not be the best. But great questions. Any other questions there with the timelines and the ID forms and so next is the administrative requirements. So as I mentioned, we are a Banker Exchange, a qualified intermediary. You must have a QI in order to do a 1031 exchange. You cannot just go sell and buy a piece of property and think you can save your taxes. You have to do with the QI. Again, anyone can be your QI, but you want to make sure that they have no relationship to you or the transaction. And the exchange agreement basically you sign that with the QI and the exchanger, and it basically says a lot of things, but the main one is that it prohibits the client to have any access to their funds throughout the whole transaction. The client can say, hey, what's in my account? We can send a screenshot, but they're not logging into the bank and looking at their money. Kind of takes you to the financing and funds. So Banker Exchange, we have segregated bank accounts. We open up a new bank account every single time for every single client. Not all QIs do that. So some QIs still commingle all the money. I'm interested to know if lawyers have segregated bank accounts. My thought would think that they would have commingling, just escrow. But I could be wrong. If you can't sleep at night, Google commingling funds with QIs. There's some big lawsuits out there. So it's not a rule. It's not a rule to have segregated bank accounts. It's just something that we do have at our company. And if your client is not using us, I would say that's the number one question to ask. Commingling funds can lose track of money fast. Same taxpayer rule is, the rule, just like the other one. The same taxpayer that sells the property has to be the taxpayer that finishes the property or the purchase of the property. So let's say individual husband sells the relinquished, individual husband files under his social, must purchase the replacement property. Or he could open up a single member LLC that's disregarded for tax purposes, files under his social, and he can buy that way. Husband cannot add wife. That changes the taxpayer. Same with an LLC. If LLC A has 4 members, it sells. LLC A with its 4 members has to purchase. The exception to that rule is you can drop out members from LLCs, as long as, as long as you do a little bit of planning. Some people like to live on the edge and do it at closing, and it can be risky, and hopefully you have a good attorney and CPA. But you can drop out either all members as tenant in common, and then they could go sell, and Joe and Sarah could take their cash, and Bob and Caroline could continue with the 1031 exchange. So that is a drop and swap. Or the LLC could purchase, and then down the road you can drop Sarah and Joe out, and they could take their cash and pay taxes and do the 1031 exchange. So there are a little bit of flexibilities with same taxpayer, but really some of the strategies could involve risk. So there are a few types of 1031 exchanges. So there's the simultaneous, which we've been seeing a lot more of. We don't normally see this one. Basically, I want your property, you want mine, and we're swapping. You actually do not need a QI if it's the exact amount of money for the exact amount of money. So if my property is worth $500,000, so is yours, we're swapping properties. You do not need a QI. I would still call a QI to make sure everything is done right, but you technically do not need one. And that's actually how 1031 exchange started. 2 farmers went to the fence. They had irregular shaped properties. They said, hey, I want mine to be straight. You take my little bit, you can have mine. Shake hands, they swap. So that's how they started. And now we have several different types. So the deferred or the forward is pretty much everything I've talked about, is selling and then buying. There's also the construction exchange or the improvement exchange, and that's selling and buying, and then wanting to take your 1031 funds to make improvements on what you're buying or construction.
Does the construction at the same time frame as deferred?
It does.
Okay.
Yes, and for that one, your construction only has to be, so let's say you sold for $2 million, and let's say you bought the property for $1 million, and you only needed to put $1 million in improvements or construction, but the whole project was going to take $3 million. Just your $1 million has to be done in the 180 days, and that includes grading, all those types of things, all the beginning as well. However, yes, you would hope that you have all your permits where you close on your sale, you purchase, and you can start moving. Yes. And then the reverse is if you need to buy before selling. We see a lot of this all the time. I'm working with one right now, where this case, they needed to buy their new office building before they sold because they needed to be able to move everything over to the new one. So they were able to buy, and then few months they're going to sell. Both the construction and reverses do take a little bit more planning because it has an EAT involved, exchange, accommodated title holder versus the QI. And basically in both of the construction and reverses, that property is being parked with us until they can go sell, and it has a new LLC, and then we assign that 100% membership interest back to the client to show the replacement property. Seems a lot, but again, like I said, we're working on one right now. Happens all of the time. You can also do a reverse construction, so buy, make improvements, and then sell. Again, I said we like heads up, though the reverse I just got did not have any heads up, but so it's totally we can make it happen, but just because we have to set up the LLC, it does take a little bit more planning. Any other questions before I jump into some case studies?
So,
Yeah.
maybe you're really dumb.
No.
Somebody do like partially the 1031 on the value of the relinquished property and they want to purchase something they need a loan on for the balance, or is it only ever just?
Yes, so if they had sold with just cash and then they want to get loan,
Yeah, because they want to put the proceeds into the new purchase, but then they have to get a loan for like the difference because.
yeah, totally fine.
So you, yeah.
As long as if the client is getting a higher loan to get cash back, the IRS will say you're
But
Feeding the
if you don't
system.
get cash,
no cash back.
Exclusively a high.
Yeah, totally fine.
$500,000 to 800,000,
Yeah.
they don't have it.
Yes, totally fine.
You put a whole 5 in and then you can get a loan.
Yes.
So,
Yes, but anytime the example of getting a higher loan to get cash back, the IRS says you tried to cheat me, you get to pay me. So anytime the client touches any type of cash through the transaction, they will pay taxes. Right. Buying up in value is totally fine. Yeah. Yeah, great question. So our fee is $1,500 and that includes 3 closings. So that could be 2 sells and a buy or 1 sell and 2 buys. It comes out of the first sale. And it just is the cost to the closing. The attorney or the title company sends us that check. It's not the client writing us a check. And if they wanted to close on more than 3 closings, it's $250 each. So 4 or more, it's $250 each. Constructions and reverses start at $5,000 plus have that forward fee of $1,500. And then expedite fee. So if you call through me, I can waive any type of expedite fee. But if we get a 5-day notice, business day notice of a closing, we will charge an expedite fee of $750.
Oh,
Mhm.
Yes.
So call through me. I can
That's for five days.
5 business days. Yes.
Do you have to have 5 full days in order to be able to make it happen?
No, you could be at the closing table and we can help you.
So you're saying reverse and construction are both 5,000,
Yes.
okay,
Starting at,
starting at 5,000.
I don't quote those.
Three
Uh,
properties.
Yes. It's because we have to form a new LLC and on paper, we are holding that property. And so we have to put that on our books. And so there's the extra work for that one.
I have one more question.
Yeah,
How often do you get somebody who is closing today?
a lot,
and they decide that they want to do a 1031 exchange?
pretty much
Today,
every day.
really?
Mhm.
Okay. And they haven't identified any properties.
No,
Okay, so this is now I'm not.
no.
Okay, because I had this
This-
happen to me about 3 weeks ago and I'm like, really?
Sometimes
Today?
the client doesn't share all of their information. I met with a realtor last week and she said, I've been working with him for months, like more than 6. We've talked about what his plans are doing. I'm helping him sell. Like I mentioned a 1031 exchange. He's like, nope, I'm taking the cash, all the things. They get to the closing table and the seller says, I think I want to do a 1031 exchange. She's like, I asked you that. And she called me and we were able to help her. But earlier the better.
Immediately need to get off the phone with me
Yes.
and you need to call somebody to talk to.
Yeah.
Yeah. Like, you can't close until you know what you're gonna do.
And there are a lot of realtors that do not, or maybe aren't aware of 1031s or don't know who to call. And so sometimes a client will get to the closing table and their attorney tells them about, they're talking to their attorney. Oh, I'm gonna take this money. I'm gonna go buy this other rental. And they're like, hold on, you need to do a 1031 exchange. And so that's also why there's a lot of panic at the closing table.
Well, it doesn't make the other agents very happy.
No, normally an attorney doesn't get it pretty happy. Yeah.
thing, because my seller just decided he wants to do a 1031 exchange. And they're like, what? Like, yeah, but, so after contacting a 1031 exchange company, he finally got back in touch with me later in the day and said, okay. I just decided I didn't want to do this. And
A lot of people do that
I
'cause-
found out that it was gonna cost you $2,250 and.
But if you would've-
you don't wanna spend.
If you would have called me and he would be a first time client for us, I would have waived the $750, even though he's at the closing table. So,
Good to know.
Yeah.
So I did not even think it was possible, closing day to. make
Yes.
that happen.
I got a call about a reverse, last Wednesday that they closed on Monday. The Spartanburg, Register of Deeds was down. They had been hacked. So the deed had not been recorded, but the deed had been signed. We were able to unwind the whole entire transactions, broker commissions, everything back like it had never started, and we closed on the reverse today. So we can be helpful. I've been working on that one for a long time, but just a lot of panic. I know.
Set him up. I honestly didn't think we could do that closing day. I think Mr.
Yes, we can. We can.
But it means you're literally not closing on the home for the seller that they're. The place they're buying, they're not.
The one I just mentioned, the seller did agree to go backwards too. Sometimes not every person of the transaction is that kind.
Seller's like, no, I need my toast.
Then we couldn't have done it. So.
My situation, like I was the seller, so.
Yeah.
You know, that's all I meant, like, you're the other.
Yeah.
Like, I can't imagine that a seller saying, sure, I'll wait another 90 days.
Oh, it was like right at a week. Yeah, right at a week. So not every person is that kind. Some real quick case studies. These are real life situations. So let's go ahead. So here's the situation. On this property, this client closed in December of 25. There was an LLC with 2 members. They were selling a retail property for $3 million and paying off a loan of $800,000. So from our exchange requirement to fully defer capital gains taxes, they need to reinvest all that cash and have the equal or greater loan of $800,000. When I was talking with them, I was asking, like, what are your plans? What are your goals? They said defer taxes. I'm like, great. Well, you should do a 1031. But they didn't want to buy anything. I'm like, okay. So talked the options. They closed in December, so 45 days was into 26. Like you could just move it out a year. Or you never know, if you find something, you can't go backwards. So if they hadn't done a 1031 exchange and they found a purchase, they couldn't say, oh, I want to do a 1031 exchange because I found a purchase. You have to be in it from the sale. Also, they wanted to take their own money and to go separate ways. They didn't want to buy together. I get that call pretty much every day too. Hey, I bought this property with my best friend and I do not want to be in any other deals with him. So I get that call a lot too. So this client was referred by the broker pretty late in the game, but we were able to help them. They called like a week out or even like within 4 days. So yes, earlier the better, but we could take them all the way to this table. And so the client ended up not wanting to take any risk. They were kind of older and remember they wanted not to buy together. So I suggested dropping out as tenant in common, but that could raise a red flag because it's changed the taxpayer. So it was an entity and now it's 2 individuals. And so they didn't want to take any risk. There's actually a question when you go to file your taxes that's for the 1031 exchange. It says, did you drop anyone out from a partnership? And if you did, you have to mark yes. And it's like red flag because you're supposed to keep the same taxpayer. And again, the client didn't want any risk. So he ended up, but his realtor found him something. I think I can go to the next slide. So that they proceeded in the LLC and they bought a tenant so their LLC bought a tenant in common interest in another property with other investors. So they bought a 4% interest and they identified that 4% interest in the XYZ property. And down the road, they plan to drop out to both get 2% of that property. It was a huge redevelopment in Greenville, and they went in with a bunch of other investors. So their long-term goal is to separate ownerships. They did only buy for 1.5 million, so they are going to pay some taxes on that debt requirement plus the cash they did not reinvest. But to them, it was worth deferring some taxes and paying some. So some takeaways is even a last-minute referral can succeed. Sometimes the simplest compliant option is the smartest. They didn't want to take the risk. Their CPA said it was totally fine. They could drop out, but them personally did not want to. And working with the QI can help avoid unnecessary IRS risk. Any questions with that one? The next one, I brought little notes.
So if you don't know if the partnership's gonna work long term, best to both have your own LLCs and.
Yes, and buy as tenant in common. It is so much easier to get out as tenant in common if you don't want to be with your best friend anymore. Like, you know, even if you see a lot of like buying with like dad and son in an LLC where, you know, son doesn't want to buy with dad anymore. So if you have, you know, dad as 50% tenant in common with son and say son wants to leave, son can sell his 50% interest in the property. And who cares what dad wants because you own 50% versus being in an LLC together. And a lot of times those entities own more than one property. So if you're trying to drop someone out from an entity that owns more properties, it gets pretty complicated. You would hope you have a good attorney too. But that's a good question. So here's the second case study. So this was a first-time exchanger, very new to real estate. Their day job is actually in Chick-fil-A, and so he's like, I don't even know what to do with real estate. So he was selling a commercial office building. I actually sat down with this client. You'd be surprised. We handle a lot of money for a lot of clients, and they never come meet us in person. They just talk to us on the phone. But we're 90% referral based, so they're normally trusted. They trust the person who sent them to us. So that's how our system normally works. But this guy says, will you meet with me? I want to sit down. Which I love those types of things. I'm always happy to talk with your clients in person, sit down with them to make sure they really understand what's happening. This guy was referred to us by really early by his financial advisor, and he sold his property for 2.1 million and is paid off a debt of 500,000. He really didn't know what he wanted to do with with his funds. So of course we sat down, you know, here's some options. He ended up identifying 3 parcels of land. One was higher than his value, so he listed one for 2.5 million. One was lower. He listed one for 300,000, and one was right in between where he would have saved some taxes and paid a little bit of taxes. And then he marked, on our form that you can mark that you're only going to buy one. So in case you do buy that one, right after you can get your funds back. So he actually ended up, I was preparing for this, I looked back. He finished his exchange. I think I did this one. Oops. He finished his exchange and he ended up not buying anything and is paying taxes. So I saw him kind of recently. He thanked me for sitting down with him because he is so glad he went through the process, even though he never bought anything. And he actually is in his second exchange and he is closing on a purchase. So sometimes it doesn't work out, but again, you don't want to have that mistake of not getting involved early. So early referral allowed for strategic planning. Client explored multiple options before deciding, and clear communication kept all options open. We talked a lot through the whole process, and so he felt no pressure of deciding. Sometimes clients feel pressured of like what I should buy and just buy something to buy something, when you should not just buy something to buy something. Buy a property that you actually want or pay the taxes, you know. And the third one is the situation here. We had a business owner relocating his operations. And so he was under contract for both properties, both what he was selling and what he was buying. And he knew he was selling for $775 and paying off a debt of $250. But his broker and financial advisor sent us we talked a lot because he wasn't sure if he was going to have to do the reverse or the forward, because his purchase, the seller was not budging on giving more time. We always suggest when it's just always easier to do a forward exchange. Reverses can be done, but it does add a little bit more complex to the situation. So we suggested give additional earnest money to that seller to buy more time, basically, for his sale to close before his purchase. And that's what happened. He was able to sell first, literally a week later. And you could do same day closings. However, we suggest that the funds come into the QI to show that they came in and that they've gone out. If the client wants a same day closing, we have to count on that attorney sending it to that attorney, and hopefully nothing.
It's stressful.
It is. Because what if that attorney is like, oh, I'll get to it. It sits on Sarah's desk who sends wires, and Sarah didn't realize, oh, well, now we've missed our wire cutoff, so we have to send it tomorrow, and they're waiting for their money at the next closing. So that's has happened, and that is a stressful situation for everyone. So we do suggest 2 days for the money to come in and go back out, just in case those situations happen. But he used all of his money. He actually bought a property for $1.3 million. So he bought up in value. So he got a higher loan, which gave him that opportunity to leverage up. So key takeaways here was advanced preparation kept options open, strong communications between COIs and the QI. His broker really kept me involved. Like, hey, here's where we are. Just let you know. You know, the seller ended up taking the earnest money, and they actually gave earnest money, I think, twice. And successfully deferred capital gains while upgrading its asset. So we got a bigger, nicer office building and didn't have to pay any capital gains taxes. And so, yep.
So like in that one, okay, it was $750,000 he was selling for.
Yes.
He would have to pay off $250.
Yes.
So $500 was his actual profit. Or
Yes.
the money that was left. That is the amount that he had to reinvest, correct?
That plus the debt.
Oh,
Yeah,
plus
the
the
full
loan.
amount.
Okay, so it's the full amount.
That's why it's pretty much the value of what you're selling
All right,
to what you're buying.
gotcha. Including the debt.
Even though there are some closing costs, and there are going to be closing costs on the other side as well. So, yes,
And then it's cost.
they do.
But not the loan,
Do what?
but not the loan.
No. And people always forget that one for sure.
That definitely needs clarification.
So a few benefits real quick on a 1031 exchange. The obvious benefit is the capital gains tax deferral. That's why most people do a 1031 exchange. However, there are some other benefits. Another one that I like to talk about is the estate planning benefit. A lot of people use it for estate planning. So our CEO likes to say, swap to you drop. So you continuously do 1031 exchanges over and over again. You sell and buy, you sell that one and buy, all in 1031 exchanges. And then taxpayer drops, and their heirs would get a step up in basis. So the step up in basis goes up to the value of the day of death of the taxpayer. Their heirs would inherit that property. And if they were to go sell that property soon after, they wouldn't have to pay any capital gains taxes, and they do not need to do a 1031 exchange. So it is a good tool if you act on it.
It goes into a trust.
Or sometimes it does go through probate if it's not set up right, which could take I talked to a client recently, he's like, oh, it just came out of probate. And I was like, oh, how, it took 3 years to go through probate. And the value 3 years ago is totally different than today's value. So now she's gonna have to do a 1031 because she missed that opportunity of step up in basis. So make sure all of your, if you have properties, make sure they're in the, where they can get probate, set up.
So you said the heirs.
Heirs, yes,
They sold shortly thereafter, after the
Yes.
person died.
yes,
Put it in.
Yeah.
Everything went to the state. Why do you say soon after? What happens if they hold it for a period of time?
yeah, so if just the value of the property could change, and the value goes up to the day of death. So let's say he died 3 years ago, the value of that property is probably different than was today, right? The 3 years ago is probably different than what they would sell it today.
Okay.
So he would have,
So they're no longer obligated, like, okay, let's say I have a commercial property, I die, it goes into my estate, my kids inherit that estate.
yes,
Are they gonna get hit with the taxes if they wait a certain period of time later before selling it?
they could, yes.
Would it just be the amount that it's increased in value, or only for the full amount of the value of the property?
Well,
Because they
that is
waited
a
6
CPA
months,
question.
1 year, whatever that magic number is.
That's a CPA question.
Okay.
Yeah. I can just tell you kind of the gist of
Okay.
how it
So
works.
you said as long as they sold it shortly thereafter, I'm thinking.
Right.
well, what is shortly?
Yeah, with it, as long, I mean, some people will say like, oh, I'm fine with the value being what it was, just so they don't have to pay any taxes. But some people are like, oh no, it's worth way more today than it was when my dad passed or whatever. The other one is portfolio diversification. So let's say your client owns a ton of land. They're not making any income on the land. They want to get an income producing property. 1031 is a great tool. They could sell their land, defer capital gains taxes, and buy an income producing property. Same with, I feel like everyone's moving to the South Carolinas, North Carolinas areas. So say your client's moving from Florida, they're moving their personal residence. Ask them if they have any investment properties they want to move as well. Not only that gives you another deal, they can also move across state lines on investment properties. That's where all the California people are moving their investments here. So we've been dealing with California is just I don't know if anyone's from California in here, but their tax board it's kind of crazy. And then there's other ones you can get, larger leverage or have different equity in the properties, but and continued investment growth. And just a little review of what capital gains taxes look like. I believe North Carolina is 3.9. We round that to 4. The net investment income tax, or that was from Obamacare, is 3.8. We round that to 4. And anytime we run numbers for a client, we use 28%. So we use the higher side to be more conservative, but it could be higher or lower depending on the client's tax bracket. So remember that when you have any clients selling any investment properties, 1031 exchange could save them some good bit of taxes right off the bat. That's really all I have. Here's my contact information. Really, I want to be a resource for you all and your clients. If you think this presentation would be great for your office, I'm happy to do more individualized into your office. I try to do a lot here as well, just to stay connected. I'm happy to, sit down and have coffee with you, lunch, or with your client. Really trying to help bring 1031s more aware and educate people, but also help their clients with deferring capital gains taxes. My cell phone number, I don't even know I have an office number, but they both reach me, but the cell phone number, the 430, you can always text it. Call me. If I don't answer, I'll call right back. I'm normally within the hour. That's all I have. If anyone has any other questions, I'll stick around. But thank you all so much, and thanks for the good questions. And I love the interaction of the audience. So thank you.